thank you all for coming. I'd like to introduce Brad Tharp, who will be our main presenter today. Most people on this call know Brad, but Brad has spent the last 6 years as the CFO and treasurer for Urantia Association International. He has many decades of experience in family financial planning and helping to set up the type of gifts that we want to talk about today. So it's great that our community has this type of expert at our disposal, and I'm very happy that he's been willing to share it, and for the last 6 years as our CFO, but continuing to share it into the future. So thank you, and Brad, take it away.
Thank you, Chris. Welcome, everybody. I'm really happy to be here. My time here as a CFO was originated as a volunteer on the fundraising committee when Mark Kurtz was the treasurer and CFO at the time. And unbeknownst to me, when I volunteered my expertise as a consultant for planned gifts and donations to the association, Mark was soon to retire. And I went from being a volunteer on the fundraising committee to the treasurer and CFO, and it was a wonderful time to come on board. There had been so much infrastructure work completed by the time I got here for fundraising and for money management. And I just want to congratulate the work that's been done since the association first originated to put us on sound financial footing and establish the infrastructure that was needed so that we could perpetuate the mission and the ministry that Urantia Association International is dedicated to. Money is, fortunately or unfortunately, a vital ingredient to ministry success. Our association has some vital expenses that must be met every single year, and we divide those expenses into two basic categories. One is our operational expenses and budget, and those include a lot of different services that all the members around the world and all of the different national and local associations benefit from. And then there are the actual projects that our many committee chairs oversee for dissemination and for communication and for study groups and for conferences and other types of book fairs and all kinds of ministries, which you can read about on our website and are certainly blasted out by email frequently to all of our members. So we're a very transparent organization, have been from the very beginning. Our books are open for view and inspection to all members and all donors at all times. We have a very strict fiduciary sense and obligation about managing our money, and we certainly do our due diligence on all projects and all expenses to make sure that our donor interests are of primary and paramount concern to the Treasury. I am supported, as Mark was before me, with a group called the Finance Committee. And on that Finance Committee, I have another former CFO and treasurer, CPA, accountants, our central office manager, and administrator. And so the finance group is well organized and well represented by a lot of different talent and skills at multiple levels. We work with the fundraising committee, which is a separate committee. And when I leave my tenure in office here as CFO, I'll be rejoining the fundraising committee as a planned gift consultant and specialist again. I'm looking forward to that that next season and cycle to come. I can tell you that one of our biggest interests and challenges is annual fundraising. It has been very successful and has grown over time and has kept the organization funded not only for our operational expenses but also for our project expenses. However, we are dependent entirely right now on year-to-year fundraising and cash donations from our membership and our friends and supporters. And one of the most important accomplishments of my predecessor, Mark Kurtz, was the establishment of an endowment fund. And an endowment is a fund that does not spend the money it receives, but invests the money it receives, and then spends only the earnings and the growth of that money over time, so that we have a perpetual source of funding for our very important missions. We still will need and will always depend upon our annual cash gifts and donations that are given to us by our donors, but we have a real interest and an important need to establish gifts, or what we call legacy gifts or estate gifts. And these are gifts that come to the association both for current expenses and for reserves to keep on hand for future expenses, but also to fund the endowment. And that endowment is very important. Mark was able to open 2 endowment funds, one just for our administrative and organizational budget, and one for the general budget with the community, with the Chicago Community Trust. Both of these accounts were seeded with money. We currently have balances in both exceeding over $40,000. We have $34,000 plus in one fund and $7,000 plus in the other. Those funds are open and available to any donor to make gifts of endowment. I was able to work with the website committee when I first came on 6 years ago, and we have a very robust and useful fundraising and donation section at the website. And the endowment is one of the restricted funds that are available for our donors to give money to. So donations are given to our general account and fund, or what we call the unrestricted account. And when it's unrestricted money, it is up to the International Service Board every year to determine the best use and priorities for that money. It can be used for any purpose, from our organizational management and expenses, operational expenses, to projects, to reserves, to future events, etc. So general funds are very, very important. It gives us at the association the most flexibility year to year, and it does allow us to maintain our operational expenses. Other than that, though, there are several restricted funds. We recognize that many donors have very specific priorities and intentions for the donations that they give to the association. We want them to feel empowered to direct and guide the use of their donations to specific causes. Indeed, if there is not a specific purpose listed in our restricted funds for donations, we certainly encourage all donors to contact myself or the fundraising committee and make specific requests with their funds, and we will certainly try to accommodate those as best we can. In addition to the endowment, and I should mention before the endowment was established, the association was also able to establish UAI as a 501c3 corporation or nonprofit organization in the United States, registered in the state of Illinois. And what that does is it means that every dollar donated to the association by an American citizen is tax deductible, fully deductible. And so that's one of the primary reasons we're here today. I am wanting to discuss and present information about the United States tax code and the different incentives and rewards that are available there for charitable giving. I can say that we are right now trying to accomplish the same thing in the Eurozone. There was a law passed a couple of years ago in the Eurozone that all countries that are members of the Euro community may make deductible donations to any nonprofit organization that is viable, bona fide, and registered in any single Eurozone country. And so it doesn't matter what country you are living in Europe. If you make a donation to a nonprofit organization that's registered in any other European country and member of the Eurozone, that gift is deductible. So we have a great opportunity in Europe that encompasses an area and a population similar to the size of the United States that will be under one tax code for deductibility, and we feel will really help us in the future to get Europe on a self-funding footing and also enjoy legacy gifts and estate planning gifts going forward. So we set up a brokerage account with Fidelity in the United States. So UAI is not only able now to accept donations and gifts of cash, but we can also accept donations and gifts of stocks and bonds and mutual funds and a lot of other types of registered securities. We can also accept donations of land and homes and other types of real property. And the advantage to the donor in the United States is many times such assets have great capital gains or a lot of profit built into them. And for example, land, a lot of times land is purchased cheap and within 30 or 40 or 50 years, it's worth a lot more money because of development nearby and other reasons. And that can create a huge tax obligation to the owner to sell that land. But the owner of such appreciated stock or property can donate that to UAI, and that donation gives them a tax deduction for the current appraised value of the asset. UAI, as a nonprofit and tax-free organization, can then sell that property or asset without any tax payment or obligation and utilize that cash. The owner has made a tax-deductible donation and yet has avoided a huge income tax on the property or asset itself by making us a gift of the asset directly rather than selling it first and making a gift of cash. This is a great method that is utilized a lot in the United States by a lot of people who donate to any kind of church or charity. And it can save an awful lot of money on the tax code. So besides just gifts of cash, one of the things I wanted to do today was talk about some of the other forms that donations and gifts can make. One of the most traditional, besides annual cash, is to name UAI in somebody's will as a beneficiary. as a specific dollar amount or percentage as a beneficiary of someone's estate. Now, as an estate planner, I recommend to all my clients that assets not be distributed by will, because a will is a set of instructions to a probate court. And probate is a public and costly process that can also be objected to by disgruntled beneficiaries and heirs. So we would prefer that you actually name UAI as a beneficiary directly on any account that allows you to name a beneficiary. That can include life insurance, annuities, it can include IRAs, it can include brokerage accounts, directly held mutual fund accounts. It can include CDs and bank deposit accounts and money markets. It can include even checking accounts. So any type of account that has a registration or an ownership tied to it allows for you to name a beneficiary. When you name a beneficiary on an account, it is not subject to your will or to a probate proceeding. At your death, the named beneficiary immediately receives that asset based on the percentage named in the beneficiary registration form. So it's much more effective and much quicker and much less costly, and it's private to make sure that people inherit and that nonprofits and charities inherit from you directly on the account level by naming the church and charity as a beneficiary directly. The other thing that should be known is that life insurance is the most common form of money left behind by beneficiary arrangement to a charity. And life insurance can be used a couple of different ways. If you want to use the life insurance to actually receive a tax deduction, you have to donate the policy itself to UAI, and UAI will own the policy. The cash value of that policy at the time of the gift is a tax deductible gifted amount by the donor. The premium paid by the donor in the future to feed and keep the life insurance policy viable is also a tax deductible donation year after year that the premium is gifted to UAI for the payment of that premium. So cash and life insurance are the two most common methods of gifts that have been given to nonprofits in the past. But the appreciated assets are gaining in popularity and certainly can help a taxpayer save tax dollars in two ways. You save taxes on the profit and you get a tax deduction for the gift made. Other than gifts of appreciated assets, which are considered gifts in kind, we receive the gift as it exists rather than the donor selling it first and then giving us cash. There are also different ways to structure trusts and make larger estate gifts. These typically usually comprise $100,000 to $1 million or more. And so these gifts are for the wealthier families and estates who are looking to make a long-time legacy gift. The charitable remainder trust and the charitable lead trust are two such tools. In a charitable remainder trust, the client, or the donor, sets up a trust, and the trust pays an income to the donor every year for the rest of their life. At the donor's death, what's left in the trust goes to the charity, to the 501c3, to UAI. The U.S. Treasury recognizes a future value of that gift to UAI and allows the taxpayer to have a tax deduction this year for the calculated value of that gift. And the donor gets to receive income for life and leaves money behind after their death for UAI. And this is a common form of charitable trust. There is a similar type of program called the Gift Annuity. And a gift annuity is a gift of cash or property that funds an annuity that pays the donor for life, and then the money is left behind for UAI at their death or after a certain period of time, 10 to 20 years usually. The difference is the trust requires more work and documentation and the assistance of an attorney, and a gift annuity is a pretty straightforward purchase and program that still needs an attorney's assistance, but is a lot less expensive and a lot less complicated. Now, when you make these gifts, if the IRS allows you to take a tax deduction for the gift, that gift is irrevocable, or there can be no tax deduction. And there's no gift recognized by the IRS. So when these trusts are set up, or these gift annuities are set up, or gifts of asset and property are made to UAI, that gift is considered irrevocable at the time the gift is made. The donor can still receive an income from that gift, but they do not have incidents of ownership. The owner is UAI, and the ultimate beneficiary is UAI. The donor just receives an income from the gift. It's typically about 5% per year of the gift made. So, for example, a donor could buy a $100,000 gift annuity or set up a $100,000 charitable remainder trust, and they would receive about $400 a month for the rest of their life, for $5,000 a year. And at their death, UAI would receive the remainder balance of the $100,000. And that remainder balance would be variable depending on how the investment that was used resulted. So there could be $80,000 left, or there could be $120,000 left. It really just depends. But the IRS allows an income paid to the donor based on a publicly scheduled table. So these are just some of the basic forms of gifting that estates can utilize. We have a gift maker's guide that Mark and I developed together and posted at the UA website. And it walks through these different types of gifts. Every gift mentioned can be easily keyword searched on the internet. Nothing that I've talked about here is new. Millions of donors over the decades have given money to thousands of charities and nonprofits utilizing these gifts. Now, one of the newest and most exciting gifts for American taxpayers that I definitely want to mention today is that the IRS now allows gifts from our IRAs to nonprofits. This is new. They first did it about 5 years ago. They allowed it for 2 years. Then they disallowed it for 2 years. And now it's back, and it's a permanent part, not a temporary part of the Internal Revenue Code. And IRAs, when people reach 70 and a half, are required to do annual taxable distributions. Whether you want the money or need the money is irrelevant. Money in an IRA has not yet been taxed, and the IRS is impatient to begin taxing, and they require distributions beginning at 70 and a half so that they can tax those distributions. Those distributions, especially if they're not wanted or needed by the IRA owner, can really cause a lot of tax problems. It can make Social Security income taxable that wasn't taxable before. It can push families into new tax brackets and result in being the most heavily taxed portion of their annual income. And so the IRS is now allowing you to not take IRA money out of the IRA and give it or donate it to UAI and then get a tax deduction. You can actually now send the donation directly from the IRA to UAI. It never goes on the annual tax return. It is a direct gift from the custodian to the nonprofit organization. Each IRA owner can do up to $100,000 per year and give money from their IRAs to UAI. This is a new thing and a very important tool because nothing is more taxable income-wise than our IRA proceeds. In addition to making annual gifts from your IRA to a nonprofit organization, now for the first time, you can also name UAI as a beneficiary of an individual retirement account, IRA. So there are trillions and trillions of dollars in the United States in IRAs. Certain families are in certain income and tax situations to where they really do not need that money. Prior law required that you leave your IRA balances to your children or your spouse. They also received it as a taxable estate gift. Now you can leave taxable balances to UAI and churches and nonprofits, and no one will ever pay a tax on those IRA balances. And then you can leave your children balances that are already tax paid. So just 10 years ago, we had to leave IRAs to children and we left life insurance and cash to church and charity. Now we're recommending exactly the opposite. It's a sea change. If you own an IRA and you want to donate money to an institution, a church, or a nonprofit organization, you want to leave them IRA money because that money is taxable to anybody else you leave it to. It's not taxable if you leave it to us. And so IRA planning is a big, big deal in the United States today. I'm going to open this up for question and answer, I think, going forward now. But I just want you to know that my role here on the fundraising committee or as a CFO, either one, is to be a resource for answering any questions that anyone might have about donating money to UAI, and to also guide you through the planning process. Everybody's estate is different. Their family dynamic is different. The form of gift that best serves and best suits each estate is going to be unique. There really is no one answer fits all situations. And so we do recommend that you talk to us about what your intentions are and what your wishes are, and we'll help guide you through the planning process to identify those strategies that would be most suitable in your situation. These strategies have great tax savings, but again, every taxpayer situation is different. So when we discuss these, we're going to be recommending that you work with your own tax advisor and verify how this is going to help you on your tax return and work in your situation. We can also recommend, if you don't already have, local estate planning attorneys near you because many of these will need some documentation and assistance. But we can help with a lot of general questions and how to fill out beneficiaries and how to transfer appreciated assets to us this year or any year that are not really legacy and estate gifts, but just current gifts. We can help facilitate that. So I'm here as a resource of information. I'm here to facilitate those gifts. And given my professional expertise, I'm happy to help anyone I can with actual consulting and planning needs that they might have. There are some gifts that UAI cannot accept and will not accept. Just a couple of brief examples, but we do have a UA gift acceptance policy, which is also publicly posted and should be referred to. But real property, for example, we're willing to take property in just about any form or condition. However, it will be reviewed and considered regarding EPA or other kinds of liabilities. We cannot accept property that is not sellable, because when we receive property, that's what we're going to be doing. We're going to sell it. And so we just have to be careful that way. We can't accept shares of corporations that are privately held or other assets of family businesses. It's got to be public securities. So that's just a couple of examples. But we'll work with you to let you know what we can and cannot accept, and how best to make the gift and transfer the value to UAI.